Here's up, guys. John here. Credit card delinquencies are at now 2008 levels, according to a Federal Reserve survey.
Credit card debt in the U.S. hit an expensive milestone this week.
For the first time ever, the total credit card debt across the U.S. has topped $1 trillion.
Credit card debt delinquencies are taking off. New credit card delinquency rates have surpassed their pre-pandemic level.
Think about that. We were told we would have a soft landing. Janet Yellen, soft landing, she said. Many times. She said this in 2007, right before the great financial crisis. Jerome Powell saying the same thing. A soft landing in sight. We're going to have a soft landing.
I do continue to believe that there's a path to a soft or softish landing.
But something very interesting is happening here in America. 1 out of 5 Americans are financing groceries on buy now, pay later.
U.S. consumers are increasingly using the installment loans to pay for everyday items, including groceries.
Think about this. They go to the grocery store, they're financing bread on installment loans, financing steak, eggs, milk, chicken on installment loans. Is this a healthy economy, or are we walking into a train wreck? Now, what I believe is going to happen is over the next couple of years, we are going to see so much wealth transfer hands that we've ever seen before. Many Americans are going to be forced to sell off homes, cars, assets, close down businesses, and many people will even open businesses based on new trends. Everything in this economy is about to change, and I believe with it, some people will become very, very rich, some will become very wealthy, and many will not because they simply don't see the writing on the wall. We're walking into a new America. And in this video, I'm going to break it down. I'm going to show you the facts. At the end, you'll make your own decision. What do you think is going to happen next? Please hit the like button. When you hit the like button, YouTube will share the content, educate more people about what's going on in America. And if you'd like to fix your credit to position yourself for this great wealth transfer, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow, for Monday. Take a look at this. So this is August, just to show you how far we've come over the last 7 months. Household debt is at an all-time high, but 2008 was still worse, right? Well, now this is Federal Reserve Bank, St. Louis. The green here is 2008, 2009. This here is where we are, well, we were in 2023, right? So we're neck and neck with that data. And this is not just credit cards, but also auto loan defaults. So you start to see the same exact thing here. The only thing is mortgages right now, homes have a lot of equity, at least presently. We could see that change pretty quickly. But presently, homes have a lot of equity. And we will see how this whole thing kind of transfers, how this whole thing kind of moves along. Because when the economy changes and generally more layoffs start to ensue, it's harder to hold on to property. So we could see a situation where many Americans may begin selling off homes. And at that time, the big question then becomes is how many Americans can afford to buy when it's 60% more expensive to purchase a home than it is to rent. Then it's just simply going to be a race to find a buyer. If there's 10 sellers chasing 1 or 2 or 3 buyers, well, the buyers are going to have to start having more and more and more control over the market. And I believe that's the kind of market we're walking into, an affordability crisis, both supported by home buyers and sellers that have a lot of perceived equity, but when it comes time to cash that equity in, it might not be there. Now, when you look at this, credit card delinquency rates climb to a decade high. 40% of Americans have missed their student loans, about 9 million Americans. And so this all is being tracked starting January 2nd when all those late payments will start ticking in. So what I think is going to happen here is I believe that these delinquencies are going to continue to rise because some Americans will choose to pay off their student loans or pay their payments. Others will choose to pay Visa, MasterCard, Discover, or American Express, right? So what's going to happen is more and more people will begin falling behind on these bills, especially due to the holiday season. Many people traveling, buying gifts, spending a little bit more during the holidays. This has not yet been tracked. But one thing that is being tracked right now is the delinquency rate, which is absolutely shocking. So this year, credit card balances soared $1 trillion the first year, right? For the first time. But what they say is, meanwhile, the share of credit card debt falling behind on the first time climbed 8% to the third quarter. That's up from 6.5% in the first quarter of 2023. So went from 6.5% to 8%. However, it's been more than a decade since the share of 30-day credit card delinquency rate was that high. Now look at these defaults for subprime. So credit card delinquencies will climb 9.5% the first half of 2023. A payday loan is probably 10 or 11% default. Payday loan, which is considered to be much, much, much more risky for the lender. But now credit cards are walking into that territory. Before, they needed to do around 9% by the end of the year. I don't see how credit card delinquencies will go from 9.5% to 9% unless we see the job market completely turn around. There's $2 trillion in corporate debt that has to get refinanced this year. So I would believe there's going to be, a tougher job market than what we've been, blessed with the last couple of years. The last couple of years, it's been really, really good for a lot of people, finding really high-paying jobs. That could change. And so if inflation gets worse and consumer credit card debt and debt as a whole becomes harder to manage due to record high interest rates with, 5.25, 5.5 Fed funds rate, I don't see how delinquencies are going to fall. I actually believe they're probably going to either remain at around 9.5% or possibly increase. But what's very fascinating here is they go on to say that with CFPB that they are getting ready to pursue credit card companies. And they're going to be doing this based on their late fees. So this came out about 3 weeks ago. CFPB ending the credit card late fee frenzy, saving Americans billions. Now you have to ask yourself, if you are a credit card company and you are charging late fees around $41 and then they get reduced down to $8, right? So you basically lose 75% of the fees for, late payments, and then you see the defaults skyrocketing to 9% or 9.5%, what would ultimately be your conclusion? If you're going to receive 75% less on late fees, consumers are going to be less incentivized to pay on time, and roughly 1 out of 10 is not paying you back, would you consider lending more money, less money, or the same? More than likely, you'd become more cautious on whom you lend money to. And that's what I believe is happening right now. We're going to begin to see this because over the last couple of years, it's been an absolute frenzy to borrow as much as possible, thinking that this party would never end. Well, 70 million, that's how many credit card accounts have been opened in the U.S. since pre-pandemic 2019. The widespread use of plastic to pay for goods points to why credit card debt is the most common form of household debt for Americans, who owe $6,000 on average. A 2023 bank rate report found that 47% of credit card holders struggle to pay off their monthly balance. Instead, they roll credit card balances over from month to month, leaving basically accruing interest and fees on unpaid balances, which is a massive, massive mistake. It's a massive mistake because these credit card interest rates are, some of these retail interest rates are 33%. 33%. So let's just use for context. On a $15,000 balance, right? And let's say for example, you're paying $450 a month, which is a lot. $450 a month on a $15,000 balance. How much do you think you're going to pay? $26,000 in interest. $26,000 in interest and 7 years and 8 months. You would think that you should be able to pay this off in 3 years, maybe 3.5 years. No. An extra 3, almost 4 years going exclusively just to interest payments. So it's gotten out of control where credit card interest rates are at. But retail credit cards topping 30% APR. Average interest rate right now is 24.25%. So on 24.25%, you're looking with, let's say, a monthly payment of say $350, you're looking somewhere around $20,000 in interest, 8 years and 5 months to pay this off. 8 years and 5 months to pay this off. So the best way to look at this is that most Americans ignore the monthly payment that they pay. They say, I'm just going to make the minimum payments. I'll think about it next month. I'll deal with this next month. For now, I just need to make the payment. Before you know it, 6 months goes by, a year goes by, 2 years goes by. And then what ultimately happens? They end up, in the same exact situation or worse because they wasted all this money that could have been invested in their education, their business, their house, whatever it may be, paying off their car. What people need to do, what people should be looking at is every single dollar that they make, how can they put themselves in a better position financially? Because if you look at what's happened over the last 3 years, it's been the erosion of the middle class. The rich are getting richer and everybody else is getting poorer. And so with this being said, playing it really strategically, looking at things, how the wealthy would look at it, building relationships with different banks, different credit card companies. You don't have to go out there, taking on all this debt, but applying for cards that you can get approved for, maybe just using one card for, filling up the gas tank, and at the end of the month, you pay it off entirely. Maybe you have some high interest rate consumer credit card debt, getting a balance transfer credit card, transferring that high interest rate consumer credit card debt to a 0% APR card, which is free to you. Then just get aggressive on paying that down. You do have to have a good credit score to get approved for that. But putting yourself in a position to where you're playing defense. Some lenders are going to continue tightening up on lending, slashing limits, others may not. So the more relationships you have, the more credit cards you have with different providers, the better off you'll likely be. Having stable income, having cash in the bank, putting yourself in a position to get rid of unnecessary expenses. All of these things are going to be very helpful, because most are not going to do this. And when you look at what happened during 2008, 2009, 2010, the Great Financial Crisis, people were forced to fire sale. So if you're in a position where you can get funding, you have lenders, you have relationships, you have cash, you're put in a position to where a bank would lend you money, and you're able to go out there and start to buy and acquire assets, you're going to do extremely well. Now, when you couple this with all of the changes that are coming to the job market, all the changes that are coming to the economy, you're going to see one thing, and one thing clearly: a massive wealth transfer is in front of us. We're in it presently, but the real transfer is right in front of us. I believe 2024 and 2025 will be those years. What do you think about this entire situation? Drop below. Let's have a conversation about it. And if you have any late payments, medical bills, charge-offs, foreclosures, any negative item on your credit report, go to GreatCreditFast.com. One late payment, just one, can drop your credit score upwards of 180 points and stay on your report for 7 years. That's another downside to this, this $8 fee. Some people say, it's only an $8 late payment. Not a big deal. I'll just deal with that later. And then it drops their score 100 points, 150 points, 180 points. And then now they can't get loans, right? This is what people need to focus on, their credit score, putting themselves in a position to get funding. So if you have any issues, we'd love to help you. You can book a free strategy session for tomorrow, for Monday, by clicking the link in the description just below this video, and I'll catch you in the next one.